Good afternoon. Jeremiah Conjure here with Annuity Association, and I'm bringing back another unbiased annuity review. Today we're going to be talking about the Fidelity and Guarantee, or what's also referred to as the F&G, Safe Income Plus Fixed Indexed Annuity. Before we dive into this review today, just want to kind of point out kind of the real design of these reviews is to help you make an educated decision on whether or not an annuity is right for you. And if so, which one's going to help you accomplish your goals, objectives, and ultimately your needs in retirement. So we cover reviews on fixed indexed annuities and any other type of fixed annuity out there on the marketplace and compare them apples to apples to bring the pros and cons, features and benefits, and really help you ultimately make an educated decision on whether or not this is an annuity that should be part of your retirement portfolio. So before we get started with this review, if you'd like to work with me directly, you can visit our website at annuityassociation.com. Right there on the main page, click the green button to request your free report, and you'll be taken to an opt-in form with a series of questions. One of those being, would you like to be contacted by an advisor? Simply answer yes, and I'll personally reach out to you in a timely fashion. Okay, so let's go ahead. I'm on the clock. I have another meeting coming up here in about 45, about 45 minutes or so, a quarter after the hour. So I'm going to go ahead and try to breeze through this one. I will not leave any stone unturned. We will complete a thorough review. Just wanted to let you know that I am a little bit under the gun, so we are going to try to breeze through this. So before we get started, let me share my screen and we will get into our disclaimer, get that fun legal stuff out of the way, and then dive into the product brochure. We will be taking a look at the product brochure as usual. If this is the first time you're checking in on our annuity reviews, we're going to take a deep dive into the product brochure as well as the software that we use here at Annuity Association to break down this particular annuity. We'll be taking a look at the index crediting strategies to see how they would have performed over the last 10, 15, and 20-year periods. We'll be identifying which index strategies are going to be the highest likelihood of positive growth moving forward based on what we call a back testing exercise, where we'll take each individual index strategy, back test them to see how they would have performed. And then we'll also take a look at our income calculator with this particular product. Since it is an income-focused annuity, we'll take a look at the income calculator to show you the logistics and mechanics of how this annuity works when it comes to lifetime income. And then last but not least, maybe if we have time, we'll dive into a sample illustration to show you on a ledger how the mechanics work for this particular product as well. So again, we're talking about the F&G Safe Income Plus 10. This is an independent review brought to you by AnnuityAssociation.com. This is a review, not a recommendation to buy or sell an annuity. F&G has not endorsed this review in any way, nor do we receive any compensation for this review. This review is meant to be an independent review at the request of website visitors so they can see our perspective when breaking down the positives and negatives of this particular annuity. Before purchasing any investment product, be sure to do your own due diligence and consult a properly licensed professional should you have specific questions as they relate to your individual circumstances. All names, marks, and materials used for this review are property of the respective owners and not that of AnnuityAssociation.com. While care has been made to ensure this review is complete and accurate, no guarantees are made to the completeness or accuracy. All right. So we've gotten that out of the way. Let's go ahead and pull up the brochure. So before we dive into the brochure, this particular annuity is obviously an income-focused annuity. We'll be breaking down those mechanics to uncover, how that works. But if you're in the market, maybe you're approaching retirement or you've recently retired and now you're looking to put a guarantee on a retirement income stream that you can't outlive, and you're getting into the market and looking for the right vehicle that's going to help you accomplish those goals, this may be an annuity that you might want to consider. There's hundreds of different income annuities available on the marketplace. So when it comes to comparing them, when you really want to accomplish finding the best one for your specific situation, it all comes down to education and understanding the different products. And we highly advise you to work with a professional. If you'd like to work with me, I'd be honored for that opportunity. If I can help you, point you in the right direction, that's what I'm here to do. And sometimes that answer is no, this isn't the one that you should be looking for, or maybe an annuity is just not right for you at all. But either way, our ultimate goal and mission here at Annuity Association is to give you confidence, clarity through education and transparency. So again, visit our website, annuityassociation.com, if you'd like to work with me. I work with clients in all 50 states. I utilize Zoom, which is a face-to-face secure platform over the internet to conduct our meetings. And if you'd like to work with me, I'd be honored and thankful for that opportunity. Okay, so this is actually for the first time, this is a little larger than I can actually see. So I had to reduce or minimize the size here. So the Safe Income Plus helps you maximize retirement income with guaranteed payments for life, preserve your savings with index growth potential and no downside market risk, and the ability to leave a financial legacy with a death benefit for peace of mind. The Safe Income Plus is a flexible premium deferred fixed indexed annuity. So who is Fidelity and Guarantee, or who is now commonly referred to as F&G? Since 1959, F&G has been the silent, unseen enabler of the hopes and dreams of millions of Americans. Today, F&G provides annuities and life insurance for over 700,000 people across the United States. The people who hold their policies were introduced to them by someone they know, their financial or insurance professionals. They collaborate with their partners in prosperity with you and the people that you care about the most. Working together, we become something greater. We become agents of possibility, agents of empowerment, agents of stability and security in a volatile world. We work together, think together, succeed together. We collaborate to help you prosper. So if you couldn't tell by that beautiful message, F&G is very customer-centric, very friendly organization. Even though they are a large insurance company, they do really appreciate and show their gratitude to their policyholders. It's evident in just the innovation of their products that they offer, as well as the way that they treat you when you call them. They are a stand-up establishment, very, very good company to consider. So what is an annuity? An annuity is a long-term retirement tool that can be a cornerstone of your financial security and success. You pay a premium, think of it as your principal, to F&G, and F&G provides an annuity contract with unique benefits to you. An annuity protects and potentially builds your savings with the option of converting them into scheduled income payments for retirement. If you're interested in an opportunity to grow your savings based on a market index without the risk of actually participating in the market, a fixed indexed annuity may be a good choice for you. This quick reference guide is intended to provide a helpful overview of the Safe Income Plus. It is coupled with the Statement of Understanding, which will be referred to as the SOU, that explains this annuity in detail. The SOU contains product information that is important and specific to you to give you an understanding of this annuity. If you decide to complete an application, your financial or insurance professional will ask you to sign an acknowledgement to confirm you've received and read the SOU. In the event of any conflict between this guide and the SOU prevails. Your financial or insurance professional is able to explain the benefits and restrictions that apply in your state. Read on and learn more on how the Safe Income Plus can play an important role in your financial security. So is the Safe Income Plus a good option for you? Well, that's what we're here to do today, is break this thing down and give you some clarity on how it can potentially help you. Safe Income Plus protects your savings from market risks while potentially giving you market-based growth with tax-deferred earnings. It is a long-term retirement planning product with these important features. They give you a bonus right up front to your account that vests over 10 years. You can choose from several options for earning interest on your premium, one fixed interest option with a guaranteed rate, and additional options tied to market indexes. Any growth of your savings is tax deferred. You only pay taxes when you make withdrawals or receive income in the future. And you have the option of guaranteed income for life. It's something that, in my personal and professional opinion, I believe is something that is important to consider when planning for retirement. When you look at all the associated risks of retirement, the number one risk that we all face is longevity. Really living longer than maybe we even anticipate because of the advancements in healthcare, the advancements in personal health and education on health. If you have genetics that are playing a role as well, maybe your parents are still alive, or maybe they've lived into their 90s or even 100s. The real bottom line, thing to consider is that, hey, there's the potential that I could live longer than I even anticipate. There's a statistic that's going out there around today that says a couple age 60 today, there's a 50% chance that at least one of them will live to be over the age of 90 years old. So 50-50 shot there that one of them is going to at least reach their 90s. And so when we look at retirement, if we're looking at retiring in our early 60s or late 60s, maybe early 70s, you still have 20, 25, and even 30 or more years that we have to make our money last for. That includes riding, the different market, economic and market conditions, withstanding any of those types of recessions that come around. And ultimately, I think the goal for all of us, regardless of what our financial situation is that in retirement, we all envision a level of happiness and peace of mind. And I think that's common across all walks of life. And sometimes having a guaranteed income stream that you can't outlive to supplement Social Security and a pension, if you're fortunate to have one, can just be that icing on the cake that you're looking for when it comes to achieving peace of mind and happiness. Okay, you'll have full access to your account for unexpected healthcare costs, namely qualifying nursing or home health care, or in the event of a terminal illness. This benefit applies to conditions that arise 1 year or more after the contract begins. From day one, you have a death benefit for peace of mind, and you may withdraw your money at any time. Withdrawals in year 1 or withdrawals in years 2 through 10 of over 10% of your vested account value will incur withdrawal charges. So this annuity does have a free withdrawal provision before income starts. If you need additional access to the monies in the account, you can access up to 10% per year with no penalty. Anything above 10% would be charged the withdrawal charges that are outlined in this product. So let's talk about the growth potential. The premium you pay in the first year grows with a vesting bonus. This particular product at the time of this review offers a bonus of 7%. So that 7%, every $100,000 you put in, you're going to get $7,000 credited as a bonus to your account. F&G adds a percentage of this vesting bonus to your account value each year for 10 years. So it will be vested over time. The longer you hold it, the more of that bonus is yours. After fulfilling all 10 contract years, the bonus is 100% yours. Now, when we look at these indexed annuities and we talk about the 10-year surrender period, or the, whatever the surrender period may be, it doesn't mean that product expires or that you have to take your money out after 10 years. You can keep your money in there if you're happy with the performance, or you're happy with your experience in that particular product. The 10 years is just our commitment as an investor. It's our commitment to the insurance company that we're going to keep our money in there for at least that amount of time. And that's how, not to get too far in the weeds, but that's how the insurance companies are able to make these products and vehicles work, because they know that amount of money is going to be there for 10 years. So they can go out, invest their own dollars to earn yield, and then pass on some of that yield to you. Your choice for tax-deferred growth, you choose any combination of these potential interest earning options. There's a fixed interest option that's set annually. It's guaranteed never to be below 1%. And then there are several options tied to the S&P 500 index. Each of the index options is subject to caps, participation rates, and/or spreads. And the index options are linked to a market index, but you are not invested directly in the stock market or any index itself. We protect you from downside risk, and you are guaranteed never to lose money due to market declines. At the end of each crediting period, any gains are locked in. The index options are not available in all states, so please check with your financial or insurance professional. So really what they're talking about here is that there's several different options on how your account can earn interest credits, whether that be the fixed account or the indexing accounts. 99.9% of our clients always go with the index crediting options. It's just, what's going to give us the highest potential for upside. But all of these indexed annuities are going to give you a guaranteed protection of a principal protection. So 0% floor is what we call it. Your account value will never go down due to market declines, and any interest credits that you accrue over the life of the policy, those are locked in upon each anniversary date, and they can never go down once they're locked in. So that's a very key feature to note. All right, so let's talk about the key benefits. Again, this is an income-focused annuity. The intention of this annuity's design is for guaranteed lifetime income. Safe Income Plus provides you with income for life as guaranteed withdrawal payments. If you haven't made excess withdrawals in any year, payments will never run out, no matter how long you live, even if your account value is depleted. You may begin guaranteed withdrawal payments anytime after the first contract year if you are at least 50 years old. The time to start is up to you, and you may stop income payments and restart them later. The payment amount is determined by the income base of your account at the time you begin withdrawal payments. The income base is different from your account value and cannot be surrendered or withdrawn. Your guaranteed withdrawal payments may increase if you become impaired to the extent you are unable to perform at least 2 out of the 6 activities of daily living. There are defined terms and may vary from state to state. Increased payments will continue until your account value is depleted or the impairment no longer qualifies you for the benefit. Payments then revert to the guaranteed withdrawal payment. The cost of the guaranteed withdrawal payment benefit is 1.15% of the income base and is deducted annually from your vested account value at the end of each contract year. So for the rider, to add the lifetime income rider in this product, the fee is going to be 1.15% per year, and that's charged to the income base on an annual basis. There is a death benefit offered in an indexed annuity, and it's no different in regards to the Safe Income Plus offered by F&G. The death benefit is the account value paid as a lump sum death benefit to your designated beneficiaries. The key also with an annuity is that the death benefit will oftentimes, and most times, avoid probate and the costs that are associated with that expensive process. So it's another peace of mind, if you will, advantage that, if something were to happen to you and there's monies remaining in this account, they're going to be passed on to your designated beneficiaries, and they won't have to go through any lengthy and costly probate processes to get that money. So let's talk about the peace of mind. There's access for unexpected healthcare costs. If you need home health or nursing home care, or in the event of terminal illness, you may access your account value with no surrender charges or market value adjustments. The diagnosis of terminal illness or the beginning of home health or nursing home care must occur at least 1 year after the contract is issued. These are defined conditions, and this benefit may vary from state to state. So one of the top misconceptions of annuities is that if you you put your money in, you're tying your money up for a long period of time with no access to it. That's completely false. These annuity companies have really developed these products to be very, customer centric. And one of those ways that they're doing that is by providing these provisions in these products that if you do have a need for confined care, home health care, or nursing home care, or a terminal illness, and you need monies to be able to afford those services and those care costs, you can access the monies in this account with no penalty whatsoever to be incurred. So a huge peace of mind there. And then again, to address that misconception that there's no liquidity in these products, that's false as well. You have the ability to withdraw your money at any time. F&G knows you may have unexpected opportunities or expenses down the road. You'll have penalty-free access to 10% of the vested account value in years 2 through 10. Any other withdrawals will incur withdrawal charges. These consist of surrender charges and market value adjustments. The surrender charge in contract year 1 is 12% of the withdrawal, and this percentage decreases each year for 10 years. There are alternative surrender charge schedules depending on the state that you live in. So if you're interested in finding out more about this product and how it can potentially help you, and you want to know the specific terms and conditions for your given state, you can contact me directly by going to my website at annuityassociation.com. Right there on the main page, click the green button to request your free report, and you'll be taken to a series of opt-in questions. One of those being, would you like to be contacted? Answer yes, and I'll reach out to you in a timely fashion to see how I can help point you in the right direction. So what is a market value adjustment? Anytime a withdrawal incurs a surrender charge, a market value adjustment will be made. The market value adjustment is based on a formula that takes into account changes in the rates since the contract was issued. Generally, if rates have risen, the market value adjustment will decrease the surrender value. If they have fallen, the market value adjustment will increase the surrender value. Market value adjustments do not apply in certain states, and they're listed here. And annuitization. So you don't have to worry about outliving your assets. You always have the option of annuitizing your contract, which means turning your annuity into scheduled payments for life. If you keep your contract until its maturity date, you must annuitize it then. The maturity date of your Safe Income Plus contract is set when the contract is issued. So this is really a rare form of lifetime income these days. Most of these products, especially indexed annuities with lifetime income riders, because of the lifetime income rider component, most people don't choose to annuitize their annuity in today's day and age. Annuitizing is basically the term used for in exchange for the contract value and giving up control over that contract value to the insurance company. The insurance company will guarantee you an income stream for life. But again, you're giving up the control over the asset in doing so. Now, when it comes down to the maturity date, those are usually set out 30 to 35 years from the date of issue. So, if you're 60, the maturity date would be age 90. And all that means is that if you've never, decided to take income and you have this nest egg of money that's just been sitting there for all 30 or 35 years up to age 90, then the contract will by default, once it reaches that maturity date, convert that contract value into lifetime income. Now, obviously, by that point, chances are most likely that you would have already done something with that asset, whether it be pulled it out to move it to a different investment vehicle, or you've already used up the income from it, and there's no longer any assets remaining in the contract value itself because of that length of time. But annuitization is still offered in every single annuity offered on the market today, but again, rarely ever used and executed. Tax information. The annuity is tax deferred, which means you don't pay taxes on the interest as it's earned, only when you withdraw it. Tax deferral may not be available if the annuity owner is an entity such as a business. Withdrawals are treated as coming from earnings first, which are taxable, and then as a return of your premium. If you withdraw money before age 59 and a half, you may also have to pay a 10% penalty to the IRS on the interest earned. Please keep in mind that buying an annuity in an IRA or other tax-qualified retirement account offers no additional tax benefit. Since the retirement account is already tax deferred, if your annuity contract is within a tax-qualified plan, you may be required to take minimum distributions beginning at age 72. You may exchange one tax-deferred annuity for another without paying tax on the earnings when you make the exchange. Before you do, compare the benefits, features, and cost of the two annuities. You may pay a surrender charge on the annuity you are exchanging, and you may start a new surrender charge period with the new annuity. F&G does not offer tax or legal advice. Consult a tax professional regarding your specific situation. Okay, so that wraps up the review of the brochure. So let me go ahead and pull up our guaranteed income calculator first. For those not familiar with our firm, Annuity Association, we're an independent firm. We work with clients in all 50 states. And our mission's simple. It's really to help people find the right annuity for them in retirement, whether it be for lifetime income or safe accumulation or just a fixed rate of return Regardless of what those needs are, if you're looking for those 3 items and you're wanting to compare all of the independent annuities on the marketplace today, we do just that for you. And again, we work with clients in all 50 states. And this is one of the ways that we do that is by utilizing our software here at Annuity Association, where we can really compare annuities apples to apples to show us, which product is going to help us meet our needs, goals, and objectives for retirement the most. So this is one of our tools here. This is our guaranteed income calculator. So right now I have it sorted for the state of Florida, which is our home base. But again, we work with clients in all 50 states using Zoom. We have a male client age 60, and then we have $100,000 going into the F&G Safe Income Plus. And what this calculator is going to do is it's going to show us if we defer the income stream. So maybe let's assume, this guy is 60 years of age. Let's assume that he wants to, retire at age 67, which would put him at full retirement age for Social Security. And maybe he wants to turn on his income stream to supplement his Social Security at age 67. So in this particular case, we would be deferring the income stream from the Safe Income Plus annuity for 7 years, activating the income stream year 8 at age 67. So what this will do is it's going to show us what the income amount would be based on the $100,000 investment over that 7 years of deferral. So the guaranteed annual income from this particular product would be $7,884 a year. Now, that's the guaranteed lifetime income amount. That's a 7.8% cash flow on $100,000 after deferring it for 7 years. And that's a 7.8% cash flow for life. Now, this is structured for single life in this example, but we also can add a spouse to cover both lives. Should you, predecease your spouse, the income stream will continue on for the rest of their life as well. Now, you're probably wondering, how does it get to that amount? How does it get to $7,884 a year? Well, let's break it down. So when you buy an indexed annuity with a lifetime income rider, the lifetime income rider is a contract. And in that contract, it's going to have associated terms and conditions, including interest rates, which are referred to as roll-up rates, and potentially bonuses. Now, if you look to the right of our screen here, and if you haven't done so already, you can enlarge your viewing screen by clicking in the bottom right-hand corner of your viewing window. There should be a little box or rectangle symbol there. Click on that. It'll enlarge your window, and you can see my screen a little bit better, hopefully. So in the rider on the Safe Income Plus 10, the compounded interest rate offered in this product is 6% for the first 10 years. After 10 years, that interest rate will drop to a 2% minimum upon the reset. F&G has the right to renew that compounded roll-up rate after the first 10 years. It can be anywhere from 6% down to as low as 2%, but you won't know until that renewal time comes. In this case, they're just illustrating what the minimum would be if we deferred it out longer than 10 years. That interest rate would drop down to 2%. Now, when you're talking about a roll-up rate on the lifetime income rider, that is just the interest rate that's applied to what's referred to as your income benefit base or your income value. Okay. Depending on the product and company you're working with, they all call it something different, but it's either referred to as your income base, your income benefit, or your income value. They're all three the same thing. And I educate our clients, when you're looking at an indexed annuity that has lifetime income riders, picture a T chart on a piece of paper. So draw your T, capital T. On the right-hand side of that T at the top, write income value or income benefit. And on the left-hand side, write accumulation value. Now, each one of those segments grow in a different manner. They grow according to different parts of the contract. So on the income value side, on the right-hand side of your T chart, that amount is going to grow based on the parameters of the rider. And in this case, that rider growth is 6% compounded per year for the first 10 years. So if you put 100,000 in that income value side of the T chart, that 100,000 is going to grow by 6% a year compounded for the first 10 years. and that's what's called your income base, your income value. And so in this case, we're deferring, in this example, we're deferring the income for 7 years. And just to the right of that large guaranteed annual income figure, you're going to see the number I just highlighted, and that's showing $160,888. That's that initial $100,000 investment growing based on that 6% guaranteed compounded roll-up rate for 7 years. It grows it to $160,000 and change. Then what else is included in that figure is the 10% income-based bonus, which is being applied to this lifetime income rider as well. And then you also have the fee that's being charged annually to the income base as well. So this is the net number that's growing over that 7-year deferral period. And then the number to the right, you'll see a decimal point there, 4.9%. That is what we call your distribution rate or your payout rate. And basically all that says is of that $160,888 income base, what percentage of that do you get distributed or paid on an annual basis? In this case, it's 4.9% of $160,888, and that's going to equal $7,884. Okay? So very simple there. If we were to defer it one more year, you're going to see some things change. The guaranteed lifetime annual income goes up, the income benefit base number goes up, and now the distribution rate also went up to 5%. The distribution rate is basically determined by your age at the year you turn it on. Every product is created differently, so they're all going to have a different scale of payout rates and what those payout rates are based on your age. But generally, the rule of thumb is every year you defer and every year you age, that payout rate is going to increase most oftentimes, usually by 10 to 25 basis points or more. Now, let's go back to our example, deferring it for 7 years, turning income on at age 67. And we see another number here to the right of our income base, and that is the enhanced income payout for the confined care, nursing home care, or home health care. So the rider states that in the event you qualify for confined care, the income amount will double to pay for the increasing cost of that care. In this case, you're seeing the $7,884 increase to $15,767 to help you pay for that care. So nice added perk there. Huge, opportunity to really give you some more peace of mind, given the circumstances of living longer. The chances are, you might have a need for long-term care down the road. Statistics show today a 65-year-old person has a 70% chance of needing some form of long-term care in their life. And if that's the case, you'll have a little bit more income to cover those costs by having this enhanced income payout for that type of care. Okay, so we have analyzed the lifetime income rider and the roll-up rates that are offered, the income-based bonus, the annual fee, and given an example of how this income works. The next step here in our review will be to pull up the what we call our performance analyzer, where we're going to take a look at the index strategies just to see kind of what they perform at in this particular product. So let me go ahead and pull that up and get that going for us. Just bear with me. If you've liked what you've heard thus far and you're getting some value out of this review, if you'd give us a thumbs up on Facebook or YouTube, and maybe even share it with your friends and family that may be interested in something like this. It really helps our video get ranked and shown to more people looking for this type of information. Okay, bear with me here. So now we're going to take a look at the index crediting strategies offered in the Safe Income Plus. Okay, got it pulled up here. Let me go ahead and share my screen. Okay, there we go. All right. Okay, so again, we referred to earlier in the brochure review the actual index strategies that are offered. They're all going to be some sort of S&P 500 and different crediting methodology that's offered in this particular product. So we'll see that the top one, when using our back testing results, comes in looking at the last 10, 15, and 20-year periods. We're going to see the 1-year S&P 500 point to point using the monthly sum cap strategy. And the monthly cap on that is 1.1%. We'll see that it's performed at 1.98% over the last 10 years, the best 10-year period. So the numbers below this 1.98, the red and green numbers, the green number indicates the best 10-year performance over the last 20 years, in this case from December 30th of 2010 to December 30th of 2020. And then the red number is the worst 10-year period over the last 10 years, still a positive number, and that's from December 30th of 2006 to December 30th of 2016. We're looking at 87 basis points during that time frame. Over the last 15 years, 1.72% average annualized rate of return, and over the last 20 years, 1.47% average annualized rate of return. Now, I must, make the disclaimer here that prior performance is not always an indicator of future performance. It all depends on how the markets unfold, which none of us have a crystal ball. But when you're looking back over these larger periods of time, specifically the 20-year period, it kind of gives us at least a baseline idea of what this index crediting strategy could potentially perform at should markets perform like they did over the last 20 years. In that particular time frame, we had two black swan events or global financial crisis events. The first one being the dot-com bust in the early 2000s, and then the global financial crisis in 2007, 2008. So, really have some stress test throughout that 20 years. And it's, really a good baseline to kind of give us an idea of what they could potentially do. Now, if you're looking at these rates of return and you're like, man, Jeremiah, those just really aren't all that great. Well, I'm not going to argue with you there. You have to understand the intention of the design of this particular product. It's not built for high index growth. It's built for competitive income on a guaranteed lifetime income basis. So if you're looking for income, this is one product you should be looking at. If you're looking for safe growth and you don't need income at this time, maybe you're just looking to grow your assets safely, then obviously there's going to be some better products on the market, some better indexed annuities that you may want to take a look at. Either way, if you'd like to compare this annuity to one you already own or one that maybe you're considering purchasing, or maybe you're just starting out in your research and trying to find out more about annuities, and you'd like to start comparing the different types of annuities out there, I'd be happy to work with you and honored to have that privilege to do so. And if you'd like to work with me, I work with clients in all 50 states. You can visit our website at annuityassociation.com. Right there on the main page, click the green button to request your free report and answer the question. If you'd like to be contacted by an advisor, simply answer yes, and I will reach out to you in a timely fashion to see how I can help point you in the right direction. Okay, one last step is to take a look at the brochure or the illustration example. So I'm going to go ahead and do that now. Bear with me while I get this pulled up. Okay, so we're just going to use male age 60, putting in 100,000, located in the state of Florida, and we are going to turn income on at age 67. Add the income rider. Okay. Okay, so we got it pulled up here. Let's go ahead and look at the current rates. So what this illustration is doing is it's looking back over the last 10 years and really applying those index returns to the account value. And then in addition to that, what this illustration is doing is it's showing us turning on that income stream that we used in our example guaranteed income calculator exercise, showing in contract year 8, turning on the income stream of $7,884. So we have the $100,000 in premium going in year one, and we see that 7% account bonus, premium bonus rather, hitting the account. And we'll also see on the income base the 10% bonus that's applied over there. So what we're also seeing, these are end of year figures, okay, to the right, all of these to the right, starting with the account value, or end of contract year figures. So if you're wondering, well, I thought it was a 7% bonus, it is. It's 7% going in, which would make it 107,000. But remember, we have that 1.1% rider that's also being charged. And then the income benefit base is growing by that 10% income base bonus. In addition, the 6% compounded interest rate or roll-up rate that's being applied by the end of the year for year one. So fast forward to contract year 8, we'll see that our contract value has grown to $106,572, and we're turning our income stream on of $7,884 a year. We'll notice that our income base has grown to $160,888, and our payout rate is 4.9%. And then we'll notice our enhanced lifetime withdrawal for confined care is $15,667. And then here, let me make it a little bit smaller so we can get everything in the window. But we'll also have a column for the rider fee, and you'll see the rider fees are being charged annually. And as that contract value, or rather income value grows, the rider fees will increase slightly as well. And then we also have a death benefit column, which will always match the account value every single year, regardless of where you are in the surrender period. So if you find yourself within that 10-year period, and God forbid you happen to pass away, 100% of the account value would be passed on to your beneficiaries in the form of that death benefit. It'll always match the account value. There will never be any surrender charges incurred. The insurance company doesn't keep your money, which is one of the most ridiculous misconceptions and rumors that are put out there with people that are against annuities. So this is just proof in the pudding that there is a death benefit, and it always matches the account value. So if you'd like to work with me directly, we'd like to get an example illustration for your unique circumstances, or you'd like to just really start narrowing down which annuities are going to be right for your particular situation in retirement, I'd be honored and privileged to work with you. I'd appreciate that opportunity. I work with clients in all 50 states. You can visit my website at annuityassociation.com to request to work with me. Just click on the green button to request your free report. Right there on that opt-in form, you'll be taken to a series of questions. One of those being, would you like to work with or be contacted by an advisor, just simply answer yes, and I will reach out to you in a timely fashion to see how I can help point you in the right direction. If you've gotten some value, please give us a thumbs up here on the platform that you're watching this on. We would certainly appreciate that as well. Thanks so much for tuning in. This is Jeremiah Conjure from Annuity Association signing off. Everybody have a great day and take care of one another. Thanks so much. Talk to you soon. Bye-bye.